Hey everybody, and welcome back to Am I Catching a Falling Knife? I'm your host, Dave, and on today's show, we're tackling a big name in healthcare, Abbott Laboratories, ticker ABT. This stock has seen a pretty significant dip in the last few days. So, is this a temporary blip, or are we about to grab a very sharp blade? Let's dive in. All right, folks, kicking things off today, we're diving into Abbott Laboratories, ticker ABT. This healthcare giant has seen its stock slide last few days. So, the big question on everyone's mind is, are we looking at a potential falling knife here? So, what's the story here? Well, ABT's stock price action lately has been all about their recent Q2 2025 earnings report. Now, they actually beat revenue and EPS estimates, which sounds great, right? But here's the kicker. The company then lowered its guidance for Q3 and the full year. Why? Primarily due to a couple of headwinds. Waning COVID-19 testing sales, remember how big that was for them during the pandemic? And some ongoing challenges in China diagnostics. This 1-2 punch led to that pretty significant stock pullback we've seen. Interestingly, despite this short-term pressure, some analysts are actually upgrading the stock, and there's still a lot of long-term optimism, especially for their medical devices and other core businesses. Before we dig deeper into those numbers, let's get to know Abbott Labs a bit better. ABT is a true global healthcare powerhouse, focused on making life better through their diverse products. They're headquartered in Illinois and have over 10,000 employees worldwide. Their business is split into four main segments: established pharmaceutical products, diagnostic products, nutritional products, and medical devices. And looking at their revenue breakdown, medical devices actually brings in the biggest chunk, about 45.28% of total revenue. Diagnostics, which we just mentioned, is around 22.28%, followed by nutritional at 20.06%, and established pharma at 12.39%. Now let's talk about the impact of this lowered guidance. We wanted to quantify just how much these waning COVID-19 testing sales and challenges in China diagnostics are really hitting Abbott. First, we looked at where these issues hit hardest. The market narrative points directly to their diagnostic product segment, and guess what? According to Abbott's own profile, that segment makes up a substantial 22.28% of their total revenue, so it's not a small piece of the pie. Second, given terms like waning and challenges, and the fact that it led to lowered guidance and a significant stock pullback, we projected a pretty significant hit to this segment. Specifically, we estimated a 14.5% decline in revenue within the diagnostic product segment for the upcoming quarter, compared to what was previously expected. That's a noticeable drop in one of their key areas. So, what does a 14.5% hit to 22.28% of their business mean for the whole company? We crunched the numbers. 0.2228, that's the diagnostic segment's percentage of revenue, multiplied by 0.145, our estimated segment decline, gives us about 0.032306. In plain English, that's roughly a 3.23% decrease in Abbott's total revenue across the board just from those diagnostic headwinds. Now, revenue impacts earnings, and typically, earnings per share, or EPS, are even more sensitive, especially when the revenue hit is concentrated in high-margin areas like diagnostics. Abbott's gross margin is a healthy 56.86%. So, we applied what we call an amplification factor of 2 points from the revenue impact to the EPS impact. Taking that 3.23% total revenue reduction and multiplying it by 2 points, we get an estimated earnings change of 6.46%. Rounding that out, our final estimated impact on Abbott's quarterly earnings due to this narrative is a minus 6.5% change. That's a pretty clear downward pressure. Now, are we 100% certain it's exactly 6.5%? No, that's why we have a confidence interval, ranging from a minus 8% to a minus 5% impact. This range reflects that translating words like waning and challenges into precise percentages requires some assumptions. While the direction is clear, earnings are going down due to the guidance cut, the exact magnitude always has a bit of wiggle room. So, what does this all mean for Abbott's fair value? We ran a discounted cash flow, or DCF model, to figure this out. To do that, we made some key assumptions. We used an estimated future growth rate of about 10.31% for the next 5 years. That's their expected EPS growth. We then applied a discount rate of 9%, which is essentially the return we'd expect for taking on the risk of investing in a company like Abbott. And for the long term, what we call terminal growth, we assumed a modest 2.5%. With these assumptions, our base case DCF model gave us a fair value of around $162.03 per share. But here's where our narrative comes in. When we factored in that estimated minus 6.5% earnings impact from the diagnostic segment headwinds, our narrative adjusted fair value came down to $149.07 per share. That's a noticeable difference, reflecting the market's current concerns. Current price for ABT is around $126.54. Analysts have a target price closer to $142.79, which is a bit below our narrative-adjusted fair value, but still above the current price. Given all this, if you're looking at ABT and wondering where a good entry point might be, our analysis suggests looking at custom buy levels around $110, $100, or even $90. These are levels where the risk-reward profile could become more attractive if you believe the long-term story outweighs the short-term diagnostic headwinds. So, to recap on Abbott Labs, they're a strong, diversified healthcare company, but facing short-term pressures. Now, as always, remember this is not financial advice. This is our take on the numbers and the narrative. Every investment decision should be based on your own thorough research, your risk tolerance, and consultation with a financial advisor. Do your own due diligence. That's all for today's episode of Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time. Happy investing!